get this number wrong and your income-driven repayment plan amount could cost you thousands of dollars extra every single year in your federal student loans. My name is Jay Fleischman. I'm the MoneyWise lawyer. I represent people with student loans and other debts, and I help them navigate a system that is as transparent as a glass of milk. So today we're talking about family size and your income-driven repayment plan. Family size is really important because the larger your family size is, the higher your income can be without it impacting your federal student loan payment. So it's important to get it right, and it's important to pay attention to it. What is included in your family size? Your family size is you, the borrower. If you are a parent that borrowed money for your child's education, you, the parent, are the borrower. Your child is not the borrower. Of course, if you took out your federal student loans for your own education, then you're the borrower. So we begin with the borrower. We add in the borrower's legal spouse if they file a joint federal income tax return. If, however, you, the borrower, are legally married, but you file a separate federal income tax return, then your spouse does not count for the purposes of the SAVE plan. Your spouse will still count for the purposes of income contingent repayment, ICR, income-based repayment, IBR, or pay-as-you-earn, PAYE. Any of those, if you are legally married and you file separately, your spouse is still going to count as far as your family size is concerned. Not so when it comes to the SAVE plan. In addition, we count any of the borrower's children that rely on the borrower for more than half of their financial needs. That's directly or indirectly. That is not a question of whether or not the borrower takes them as dependents on their federal income tax return. Your child could be 45 years old, living completely all the way across the country, but still relying on you for their financial needs. They count as part of your family size. That's it. So it doesn't matter where your child lives, it doesn't matter how old they are, and it doesn't matter if they are a dependent on your federal income tax return. If they rely on you for more than half of their financial needs, directly or indirectly, they're part of your family. Last but not least, anybody else that lives under your roof, no matter who they are, whether they are related to you or not related to you, if they rely on you for more than half of their financial needs. That could be a parent, that could be a grandparent, that could be nieces, nephews, grandchildren, aunts, uncles. It could be your friend from high school that kind of peaked in senior year and never really went anywhere, and now they're couch surfing and eating you out of house and home. Well, if they're sitting on your couch, eating you out of house and home and not giving money towards their own overhead, congratulations, they count as part of your family for the purposes of your income-driven repayment plan. Make sure that you calculate that number correctly every year, every time, because it's important to make sure that your family is properly reflected. If you've got any questions about your federal or private student loans or any debt whatsoever, again, my name is Jay Fleischman. I'm the MoneyWise lawyer, and you know where to find me.